Do you check your stock app every day? Maybe you're stuck with a Microsoft wondering if you should buy more or you need to sell more. Or maybe you're watching the Amazon stocks or guessing if this is already like finally hit the rock bottom. Should I buy Amazon now? Or maybe some of you might really want to buy the Meta stocks, but your finger just freeze over the buy button. I totally get it. Big tech just went through its worst month in years. The famous Magnificent Seven lost mind-blowing $2.3 trillion in just a few weeks. But guess what? While normal investors were running away in panic, Wall Street giants were quietly scooping up these stocks. If you watch this video to the end, you will get three key takeaways. First, where the real cash is hiding in this AI boom. Number two, why the smart money is buying so differently with the normal investors. Number three, how you should look at the tech stocks you own or want to buy. Okay, then let's dive into the what actually happened in June. Throughout June, tech stock prices tumbled down like a ball rolling down a staircase. It all started with the US job report. The job market was much stronger than expected. You might think, wait, strong jobs are good news, no? But the stock market hated it. A hot economy means the central bank will not lower interest rate anytime soon. Actually, the interest rate for 10-year US bonds went over 4.5% and 30-year bonds passed the 5%. Think of bond rates as the base cost of borrowing cash. When this rate goes up, AI companies that borrow huge amounts to build massive computer centers feel a lot of pain. On top of that, the chipmaker Broadcom didn't give a super strong outlook for AI processors. This shook up other hardware stocks, making the Nasdaq index dive more than 4% in a single day. By mid-June, the mood got even darker. People started warning that today's AI rush looks exactly like the scary 1999 dot-com bubble. But the biggest problem hurting the market all month was something else. These companies are spending a huge amount of money to build AI. Amazon, Microsoft, Google, Meta, and Oracle plan to spend nearly 700 billion this year just on data centers. The scary part is how much of their earnings goes into this. A few years ago, they spent about 40% of their cash on investments. This year, it's around 90%. They're making great money but throwing almost all of it right back into building more servers rooms. Take Microsoft, for example. They bumped up their spending by 85% in just 1 year, but their leftover cash actually shrank. This means fewer stock buybacks and lower dividends for the people who hold their shares. Plus, a rumor popped up. Google and Amazon gave a ton of funding to an Anthropic. That Anthropic used the same money to rent cloud space right back from Google and Amazon. The market started to wondering, wait, guys, are you guys just like passing cash and back and forth to fake bigger sales? To sum it up, this stock drop didn't happen because of bad profit. It came from a deep fear. They are spending so much, but will they actually make real profit later? In this scary mood, it is totally normal for everyday investors to sell. But right at this exact moment, Wall Street whales started buying. One famous player doing this is Bill Ackman. In Ackman's investment bag, Microsoft, Amazon, and Meta make up more than a third of the total pie. Basically, he's betting his firm's future on these three names. While big tech was suffering, Ackman shared a report saying, "This is why we feel strongly positive about these firms." He brought up the year 1999. Let's jump back in time for a second. Back then, the world was crazy about the internet. Any stock with .com in its name shot up in the sky. But one investor was getting mocked by the public, Warren Buffett. His company held lots of old boring businesses like bricks, paint, and insurance. People laughed at him, asking why he was ignoring the new digital age. That year, the Nasdaq index sold more than 85%, while Buffett's stock dropped almost by half. But we all know what happened next. The dot-com bubble popped in 2000. Trendy internet stocks crashed hard and tons of startups vanished completely. On the flip side, the mocked, boring companies that steadily brought in real cash were the ultimate survivors. Ackman's point is clear. Today, Microsoft, Amazon, and Meta are just like Buffett's old company back then. Everyone is chasing shiny, exciting AI names like Nvidia, SanDisk, treating these steady cash-making giants like they are outdated. There is a specific spot where the true wealth is made in the AI game. To get this, we need to split AI business into two groups, cafe and building. The cafe is the AI models. Think of ChatGPT or Claude as the coffee shop selling coffee. You ask a question, they give an answer, and you pay based on the usage. The coffee is a token, data pieces, and brewing is called the inference. The cash goes straight to the cafe. The landlord is the cloud providers. The second group, the buildings where the cafe rented its space. Amazon, Microsoft, and Google are the landlords. They build giant computer factories and rent out the computing power. ChatGPT and cloud must run inside these buildings, paying rent, which is cloud fees, based on how much power they use. Right now, a crazy price war has broken out among the AI cafes. New cheaper models like Llama or DeepSeek are popping up. It is like a budget coffee shop opening right next to pricey franchise. Naturally, ChatGPT and Cloud have to drop their prices so they don't lose customers. But watch closely. This price war is only between the cafes. The landlord sit in the completely safe spot. Even if a user switches from the prices cloud to the cheaper Llama, both systems still run inside the same cloud. The sign over the coffee shop door changes, but the landlord still collects the rent. But you can think, if both switch to cheap AI, isn't the landlord make less money? Actually, that is not true. When AI becomes super cheap, people gonna use way more. They start giving AI all the chores they used to skip. As usage blows up, the landlord rent check gets much fatter. In economics, this magic effect of the cheap tech causing exploded usage is called the Jevons Paradox. This explains why spending billions on data centers isn't as crazy as it looks. The landlords are pouring concrete now because they know a massive wave of gas is coming. The starting cost is heavy, but once the rooms fill up, rent just keeps rolling in month after month. Plus, they have a powerful moat. Amazon, Microsoft, and Google don't just rent out raw computer chips. They hold their clients' security systems, daily tools, and payment setups. Moving to a new provider isn't like picking a new coffee shop. It is like packing up your entire family home and moving to a new city. Because it's so annoying to move, clients stayed locked in, giving the landlord endless cash flow. This story isn't just about whether AI is going to win or lose. The real question is, where exactly the money flowing? While everyday folks were busy watching the street fight between rival AI coffee shops, cafes, Wall Street pros quietly placed their bets on the landlord. Also, these big tech stocks are slowly starting to lift their heads again. Of course, there is no 100% guaranteed investment. There is a chance that AI investment can fall down and all the stocks, include Magnificent Seven and big tech companies, can fall down either. But there is a lesson. Having the vision to spot the hidden landlord when everyone else is just chasing the shiny name, that could bring you real money and make you real rich. If you enjoyed today's video, please hit the like and subscribe to the channel. I'll bring another interesting stock and market insight. See you in the next video.